I'm Dylan Radigan. I've interviewed nearly every CEO and most world leaders during the past 25 years, and now I'm bootstrapping. I'm turning my attention to the new CEOs and the irrepressible entrepreneurs leading the next generation of innovation in the world. Welcome back to Tasty Live. I am Dylan Radigan. Time for another episode of Bootstrapping. Our guest today, Craig Cecilio. The fund or the business called the Diversity Fund, headquartered in San Diego, real estate fund, $100 million invested, 30,000 different people have signed up to participate. Sounds a little peculiar for an institutional real estate fund. And that's because Craig's premise is to make larger scale real estate development and commercial development style investing, which is typically reserved for high net worth or very high net worth individuals, accessible to a much broader market. Craig, it's a pleasure to meet you. Nice to have you here.
Thanks for having me, Dylan. Appreciate it.
Why did you want to create a real estate fund for big real estate deals for the little guy, basically?
Yeah, I've been asking myself that question the last 2 years after I started this. It's a lot of work, but it had to do with my childhood, being brought up in more of a working class family, and my parents really weren't exposed to investing, wealth building techniques. And I was fortunate enough to kind of get involved with this at an early age. And when I saw the opportunity to take this and be able to give it to everyone, I call it the everyday investor, I was like, this is what I'm supposed to do. So that's the passion behind it. So I had a skill set of raising capital, putting structured real estate deals. And now with some of the regulation that came out of the Jobs Act, you could drill that down to anyone, regardless of your socioeconomic background. So no matter what,
can you talk about that a little bit? Because I know that with investing, they have all these suitability requirements, I believe they call them. And that's the sort of thing that tends to prevent people who don't have a qualifying amount of money, whatever that is, depending on the investment, from participating. It could be whatever the number is, but it can easily be 7 or even 8 figures to qualify, depending on either the regulatory burden or the gatekeeping for the fund itself. How does this change that?
Yeah, the exemption came from the Jobs Act. It's this kind of crowdfunding. It's Regulation E+. You got to get qualified to the SEC to offer that. So you have to send all the paperwork, and the SEC has to qualify you so you could offer this. And it's really just 10% of your net worth. So it means if your net worth is $5,000, you can invest $500.
So you're saying that the suitability under the Jobs Act is that's it. There's no floor other than 10% of your net worth.
10% of your net worth, correct.
Okay. So then the second issue is, as I'm sure, as you already have referenced, having a lot of different investors creates the potential for substantially more paperwork.
Yeah, so that's where we implemented technology. That's where we created the platform. This is where the fintech comes in, financial technology. So create out technology, product, really made that user journey so it's all online. It's done through an app. You can go to a website as well. Very easy to transact. All the documents are stored online. You can transact online. There's no wiring. It all gets connected to your bank account. Kind of similar to kind of like how you operate like a Robinhood type of thing. You could say we're similar to kind of Robinhood in that aspect is, hey, it's very easy by click of a button to transact.
And then so let's say I have an account I put $500 into my investment on your app. How does that money filter into participating in the transactions that you're offering?
Yeah, so what it does, you put it in and it goes into an account, right? And as we aggregate enough funds, we go out and deploy that into a real estate transaction. So we have the volume now, that happens pretty quickly.
Okay, so but what's your filter for real estate transactions?
Our filter, we focus on multifamily assets throughout the U.S. Geographically, we chase the robust markets. Mainly, we've been the last few years in the Sun Belt region. And so we're purchasing assets about 20 to 25 million. And so that's where the everyday person, I like to say, doesn't have the opportunity to participate. So they're pretty much institutional grade type of investment opportunities.
But it's multifamily residential is your sweet.
Correct. That's our sweet spot.
And then you're harvesting a yield from renting out the units. Is that the thesis?
Yeah, we had mostly the really kind of the meat of the investment comes with the appreciation of the property over a few years, and you teach time to market appropriately.
Got it. And so that brings us to the real estate market, which is a famous asset class in its own right at all times, and particularly notable at the moment because of the interest rate environment, the mortgage rate environment, all those things. What is your assessment of what's your top line assessment of the market? I guess we'll start at the top.
Well, our asset class is pretty robust. It's pretty risk adverse compared to everything else, and especially in downturns. I like to look back on the pandemic when that first hit. We were buyers. When everyone was kind of running, we went in and bought a lot of multifamily assets. We really had great returns from that. So I look at the same time period right now. It's distressed because when there's a lot of uncertainty, to me, that's a distressed time period. So there's still deals out there, but you have to be careful because we're in this environment with the interest rates being higher. So you have to be more cognizant what you're doing and look at better underlying fundamentals than you would a few years ago.
My experience with people in the real estate industry is that they are all, no matter what is happening, they're always optimistic.
We are optimistic. If you have experience,
so I'll grant, and I don't mean to interrupt you. So I'm not here to rain on your parade. Let's assume that your asset class is the one, that both your market timing and your asset class puts you in a much better position than the vast majority of people in the market.
Correct.
But again, not your business. Commercial real estate in San Francisco, for example, has higher vacancy rates today than it had during the pandemic or 08 or 09. The banks are all wrapped around a tree 10 ways in some of the private equity funds, depending on the bank or the private equity fund. It's clear, Class A commercial real estate, not just in San Francisco, is going to be repriced, restructured, everything because of things we all know, work from home, et cetera, et cetera, et cetera. Is there an opportunity for you there? Would you migrate into some of the distress in commercial? And that on the one hand, and on the other hand, does the distress in commercial pose a risk to ripple more into the residential market?
Yeah, I think we're talking a little bit about office, and office is still a little scary because there's a lot of behavioral things that changed due to the pandemic. So it's different. It's not like it used to be, hey, the market slid down, but are people going to go back to the office? Or if people have a choice to get a job where they could work from home. So cities like San Francisco, I'm not sure if there's a chance for them to come back because the culture there is to work from home. So it's more of a behavioral thing. But whereas multifamilies come in, a lot of people can't afford to purchase a home, especially right now with the interest rates even being higher. So multifamily is pretty robust. There is a lot of new product in the market. So you got to look at the specific markets a little bit more on a market by market basis, and just kind of look at those underlying fundamentals of the jobs market there as well. And you don't want to lever up as much as you would in a accelerating market. So you really need to put more money down, more of a down payment down.
And then what of the single family residential market? Do you have a point of view there? In other words, it sounds like what you're saying is what may be bad for single family, or for that matter, bad for commercial. All of those things are good for multifamily. Am I misinterpreting that?
Yeah, single family, we're talking about purchasing properties to live in, or are you talking about
live in?
That's tough. With the interest rates are almost doubling and tripling, the purchase power is going down. So there's going to be a readjustment there. What that is exactly, we're starting seeing that in some areas across the country. But we're not in that space. We're not investing in that space.
Sure.
A little speculative in nature too. If you time it right, you do make a lot of money. But there might be some opportunities in that area as well.
And then how do you distribute your returns back to your model to complete the loop? So I put in my $500. You've aggregated my $500 with a bunch of other $500 or more, and now it's been allocated to. Does that money go into a specific building, like an SP, a special purpose vehicle that is to own that building, or does it go into a fund that owns multiple buildings? And then how does the money come back?
Great questions. We have different types of products. We have funds, and some products are direct investments in the property themselves. So the fund, you have to look at the overall holdings of the fund, if it's cash flowing. At the end of the year, since it structures as a REIT, those dividends gets passed to the investors, as well as if it's a single asset, that single asset is performing well, those dividends gets sent out to those investors and LPs as well.
And how I'm fascinated by the number of people, and you're saying technology allows you to because it sounds like a horrifying amount of paperwork, but maybe that's because I'm imagining somebody in a basement smoking a cigarette in 1977. And that's just not how it is, obviously.
It's through technology. The technology allows you, the opportunity came from the technology. Without the technology, it'd be dead in the water.
Now that allows the paperwork and record keeping.
Exactly. It's all automated. It's all automated. It's all set up. All from the front the cycle to the back of the cycle to the back office. We all use data. We use automation. We use coding and all that stuff to put it together to make it more affordable. That actually lowers the barrier to entry because we get efficiencies through technology, which lowers the cost, allows us to go down in that size of investment amount. We're making it more cost effective.
And what's your record? How are the returns?
Well, like I said, when we bought really well, as our company grew, we had a lot of capital come in during 2020, and we deployed that. And that was a great market. And so we did have a few go full cycle, but they were really great returns. And I don't want to talk about those returns because it's not sustainable to go north of 20% on your IRRs. It just is a byproduct of last year, the first half of last year. Last year was like 2 years. 1 year, I felt like the first half and second half, right? With things was really frothy the first half of the year.
Yeah.
We did really well with that time period with our assets right then. But I don't know if that historically we're going
to... What about just, you've been around since 2016, though. You have, some blended metrics, I would imagine, at this point.
Yeah, I mean, it's pretty good. The reason I'm not articulating that, there's a lot of compliance involved, and if I don't, so I just say, hey, we're doing really well. We're not really, not correlated with the stock market. That's a big thing, as it fluctuates so much. We're not, our asset class is not correlated with the stock market at all. So,
but for example, if I buy my $500, I'm assuming you're not you're not creating a synthetic price and giving me a real-time value that's just made up, or are you? I don't mean made up, but it's derived from some inferred.
Yeah, historically, we try to outperform the S&P 500, and we have. Man, that's kind of our target. What we try to do is try to get the load but markets change. Like, we're trying to be north of, and I don't want to say just because of compliance reasons, we're always trying to target the highest returns we can get.
Sure.
I've been around in real estate since the late 90s, so it's not this company I just started in 2016. So I understand, looking over a decade for the data, not just over this little 2-year time period. It's very frothy.
My additional question is, what's the customer experience in collecting returns? For whatever the returns may be, I don't care what the numbers are. At what point, in other words, can I sell my $500 anytime? Are you making markets, or is it locked up for some period of time?
Yeah, right now we have that locked up. It's full cycle, 4 to 6 years, full cycle with your money. It's really the appreciation you get in that asset really protects you. It's a couple down years.
And then after 4 to 6 years, there's a distribution from the fund or from the transaction at a scale.
Yeah, we try to time the market. So, hey, we say to 4 to 6, you want to time it correctly. Last year, let's talk about last year. First half of 2022 was a fantastic year to sell stuff. Now, not so great, right? Interest rates are rising. A little of the stuff on those asset classes themselves, there's more expenses thrown at this stuff. So it's not, today I wouldn't sell assets as much. I would hold on to them a little bit longer and see how the next couple of years, what that looks like before I would.
But the investors get paid when you sell the assets.
Correct.
Yeah.
Yes.
Would you imagine using the platform that allows you to navigate all the paperwork and all everything you've described, the technology, to assign it to other investor classes for the 1%, as you call it?
We are entertaining doing that as well. We want to knock this product out. It's very tangible. It's very easy to understand for people. For people who haven't done it before, I always categorize 3 people. I've done this asset class before. So if you've done this asset class before, you're most likely a sophisticated investor, an accredited investor, and have a high net worth. But the majority of our cohort is kind of the middle class and people who haven't done this before. So there's a lot of education involved. And since that's the case, we want to keep it simple. People understand real estate for the most part. And so that's what we're leading with. This is our first primary product. And it's a huge market. It's $1 trillion market at the end of the day.
Yeah.
So we just focus on that customer experience. There is, my biggest thing here is there's so much education that's involved. And we're working with that and working with the regulators, because the laws just change all the time. Unfortunately, we're a direct-to-consumer platform online. And with crypto blowing up, there's all this regulation coming down to crypto, which kind of oozes into anything online. So we have to kind of navigate those waters carefully.
Mm-hmm. I mean, are you concerned that that might create some regulation that would limit the window on the Jobs Act?
It can. I concern it's going to increase the costs, because with more regulation means you have to hire more people to work on compliance, and that's more cost there. But we're at that level right now. I think we're big enough that that's okay for us, and I actually applaud that, because that's going to create more higher barrier to entry for competitors. So I think we're in a good position that there might be less people coming out of the market, which makes our product stand out a little bit more, our company stand out.
And then I guess my last question, just going back to multifamily as an asset class, do you think multifamily is actually counter-cyclical to growth?
Well, our asset, we like the BC markets, not the A markets, where a lot of the new builds are being made. And historically, they've done well in down periods compared to the other asset classes. So again, we're trying to mitigate risk as much as we can in this asset class, give it something, another choice for people to have. So right now, as you know what's going on in the news, you have your money in the bank. I've been in all regional banks personally. It was a nightmare going through that escapade the last couple of weeks. And what are you getting for your money? So this is a good place to stick a portion of your portfolio into real estate, because historically it's risk averse.
Diversifund. That's and I'm assuming it's diversifund.com, yeah?
Yeah,
yep. Looking at it right now. Yeah. Real estate investing that's accessible for everyone, and it's easy too.
Very easy. All you have to do is make sure to read everything, but it's very easy to do. You go on, click the button, here's the button, your bank account, very easy to transact.
It's a pleasure. Congratulations on your success and the merits of your idea, both socially and economically.
Thanks, Dylan. Appreciate it.
All right. Craig Cecilio out of San Diego, Diversifund. Check it out. I am Dylan Radigan. You have been watching Bootstrapping. More Tasty Live right after this.